because I have a lot of great information today, and we have a special guest. So I'm hoping that we're going to get through everything that we want to today. But this is going to be what I hope is going to be a really quick, fast, and value-packed session for our wealth building mastermind. And I just want to welcome Ed Estrada. He is from Orange Bank and Trust, our favorite banking institution. We do use them for our many companies that we have. They have been a great friend and a partner. And that's the first thing I want to tell you about, going and finding a commercial lender. We have had a lot of success over the years in using smaller community banks because they are in the relationship business. And when you're a smaller investor, you sometimes do not fit, the mold that some big banks have. And the people at Orange Bank and Trust and some of the other institutions we've used over the years that are community banks get to know you. They get to know who you are, what you're doing in the community, and they care about that as well as your balance sheet. So with that said, I'm going to bring Ed on, and I see he's just put his contact information into the chat. So welcome, Ed.
Welcome, everybody. How's everybody doing today? Good? So I'm going to try to make this as conversational as possible and to hopefully guide you guys with some information when you go out and you're looking at investment properties, whether they be 100% residential apartment units, or whether they are mixed-use properties where you'll have a commercial enterprise, typically on the first floor, and then residences on the upper floors for the most part. So, and pretty much with everything else, most banks, which sometimes is a misnomer for folks who don't understand our side of the industry. Most banks are what we call cash flow lenders. They are not collateral lenders. So sometimes we'll have a customer come in and they won't have great cash flow and they won't understand why we can't do the loan because they have either a great loan to value because what they're borrowing is minuscule compared to the value of the property. But we are not considered collateral lenders, and typically federal regulators frown upon institutions providing financing just based on the value of the collateral, because typically what they're saying is you're giving somebody a loan that they can't repay back to you because there's no cash flow, and you're doing this just to gain access to the asset. So the first thing to understand is that we are cash flow lenders, and what that will mean is that if you have a prospective buyer for a commercial property or an investment property, it's important to understand the rent flow that they will be getting along with the expenses of the property to determine whether or not it's feasible for them to get financing for that particular location. So the three things and when I speak to a prospective client, I pretty much tell them the same exact thing. There are three things we will always look for. And each of those things have a bar to it. And obviously you want to be above that bar in order to ask and get an approval for the financing. But it doesn't necessarily mean that if you fall short in one area, that you will say no. It just typically means that the other two bars you have to far exceed those in order to compensate and mitigate the fact that the other bar, so to speak, is low. So those three things are typically cash flow, collateral, and then what we call a tertiary source of repayment, which is typically the person that's buying the asset. Even though they might set up a real estate holding company to purchase the property, they are still the principal and owner. So they would be kind of like the third way out for a bank. So what I'll do is I'll go through each of these three and what the bank looks for in each of them, so that at least when you guys go out there and folks might be asking you, or you might even ask them, if you have somebody who's looking to buy a property that you have listed, you want to understand whether or not they're going through this process and whether the information they're giving you in your mind does qualify them financially to be able to purchase the property you've listed. So from a cash flow perspective, a bank is always going to be looking to assess that area via tax returns or financial statements. So if the property is being purchased by an individual straight up and they're not going to set up a real estate holding company, we would require 3 years of their federal tax returns. And you need to make sure that it includes all of the schedules or any K-1s if they're applicable, or anything else. It needs to be a complete tax return. And the reason why banks typically look for 3 years is because they are more, from a conservative underwriting standpoint, they're looking for consistency from the individuals for the most part. So in an individual, and why would we need the personal tax return is if the person selling the property owns that property under their own name, the asset, that property is going to be listed on their Schedule E of their tax return. And that Schedule E is going to show the address of the property. It'll show what rents are being collected, gross rents. It'll provide for all of the expenses in that given year for the property. And then it'll come down to a net income figure. So property minus expenses is going to get you net income. And then what banks will do to assess their ability to pay back whatever the mortgage is that they're requesting is they will consider a couple of add backs to the bottom line. So let's say you've got $100 as your gross rent and you have $50 worth of expenses. That means your net income on the property is $50. And then if any of those expenses include depreciation, interest, or amortization, those 3 items would be added back to the bottom line. So let's say that of those $50 worth of expenses that you have, $10 is depreciation expense, $5 is amortization, and another $10 is interest. Well, we would add back that $25 to net income to come up with a total of, I think that's 75, and 75 would be what we consider your net operating income. And that $75 is what we look at to be able to service whatever the mortgage debt is. And what the parameter, the bar that I was talking about earlier for cash flow of a particular property is the debt service coverage ratio that we look at. And typically, let's say your mortgage debt, I give you financing terms for, a $50 mortgage at 7%, amortized over 20 years. And let's say that debt service in 1 year's time is $30. So if I take out because I'm a broadcast major and not a banking major, that's why I use a calculator all the time. So $75 in net operating income, if you then divide the $30 that I said the mortgage debt would be, then that results in what's a debt service coverage of 2.5 times. And the minimum standard for most investment properties is 1.25 times. The more you are north of that, the stronger the cash flow is on that property, and you'll pass that test that the bank looks for on one of the 3 items. The second item that we assess is collateral. And by the way, so we would need 3 years tax returns on the person who's going to be borrowing the money. We would need also 3 years, as much as you can get, on the property that you've listed or the property that you're buying, depending on what side of the street you're on. So let's say you're selling that listing. It would be very beneficial to the buyer of that listing to be able to have 3 years of information on the property that's listed as far as gross rents, less expenses, and what the net income is on that, because a bank is going to require that. If they do not get it, because obviously some sellers don't like to provide financial information on their properties. If that's the case, then we will probably typically rely on any property income and expense that the realtor may have. And we're also, as part of the appraisal process, that appraiser is going to require information on the leases and to just kind of confirm how much income the property is generating. So regardless, if you are selling the property, you're trying to make that property look as cash flow flush as possible for the bot, not only for the seller, but for the people who are supporting the seller in regards to financing. If they can't get a history on the income and expenses of that particular property, that will provide an obstacle for the bank to do financing on their behalf. So it's important as realtors, where you are selling a property on behalf of somebody, that you kind of communicate to them that you're trying to make it easier for them to sell the property. And one way to do that is to be very upfront about what the income that's being generated and what the true expenses are. There are people, I've been doing this for 30 years, that don't like to show cash, don't like to do anything of that. And typically when I talk to a customer, I said, if you need the bank in any way within the next 5 years, then you need to start showing as much cash as possible. So if you, and I used to be a manager down in Greenwood Lake, where there were a lot of small mom and pop businesses, as well as in Warwick. And so they didn't show a lot of cash. So again, I would tell them, if you don't need me, that's fine. I understand what you have to do with Uncle Sam. But if you have to come to me for financing, you got to start reporting cash at least 5 years out, because at the end of the day, we're going to be adhering to Uncle Sam's rules, because when they come in to check our books, they're going to look at whether or not, a particular loan cash flows. So that's the first step, is the cash flow. The second part of the equation is the collateral. And this is where we would get our information via an appraisal. The appraisal has to be ordered by the bank itself. So if a customer says, oh, let me order it ahead of time so I can give it to the bank's not going to be able to use it. Federal regulations in regards to appraisals do not allow for the borrower to be the person of contact when it comes to ordering an appraisal. They need to have the transaction be arm's length. In 2008, when we had the real estate crash, it became even tighter for bankers. So for instance, back in the day, I used to be able to order appraisals for my customers. And then I'd go back to the customer and say, okay, what's more important for you, the cost of the appraisal or the turnover on how long it's going to take them to get you the appraisal? Customer would choose, I'd order the appraisal. And typically, if I had somebody who I always knew well, I would always go back to that company. So nowadays, after 2008, a loan officer cannot be the contact when it comes to the appraisal. So we have a different section of the bank that does blind bids. We use a third-party vendor. In our case, it's called Mountain Seed. They go out and they do the bidding process on the appraisal. They come back, they provide us typically with about 5 or 6 appraisal bids, all anonymous. And the only thing I know is what the dollar amount is that the appraisal is going to cost and how long it's going to take them to do it. And then I provide that information to my customer, and we decide, okay, this is the best approach for us. We like turnaround time better. It doesn't matter what I pay. So let's go with this person. And then I let that other side of the bank know, and they go ahead and order the appraisal. At no time am I ever allowed to contact the appraiser. They have to coordinate, coming out to the site and visit directly with the borrower. And then they provide us with our report. All banks typically will lend on a commercial property or an investment property, and that would be more in excess of 4 family. You can do 1 through 4 family through our residential mortgage area. But once you go beyond 4, it becomes a true investment property that only our side of the bank can do on the commercial lending side. 75% of the appraised value or the purchase price is what the bank can lend. So if you come in and you have an appraisal that comes in at $1 million, I'm only going to be able to lend $750 to the borrower. They're going to have to come up with the other 25% on their own. If for some reason the property comes in at $1 million, but the sale contract is $900,000, I can only lend up to 75% of the $900,000. Whichever is less between the contracted price and the appraised value is what we utilize as that 75% cushion for it. So that would be, so that's our second source of repayment that I was talking to, and the bar on that is, like I said, 75%, and that's based on an appraisal that we get from a company that bids out. And then the third part is what I called earlier our tertiary source of repayment. That is the principal of the transaction. So if somebody sets up a real estate holding company, anybody that has a 10% ownership or more in that real estate holding company would be subject to guarantee the loan personally. And we call those unlimited personal guarantees. And they're in existence throughout the end of the mortgage. And we assess the principals through a personal credit report, as well as their tax returns, which we might already have if they're the actual borrower. But if they've set up a holding company, we typically would need 3 years tax returns on the holding company and then 3 years on the principals, each personally. So of the three, and on the tertiary source of repayment, the bar level for that is you need to obviously have a satisfactory credit report. And we have what's called a one-time debt service coverage for what's called global. So I talked earlier about the fact that on the business side, it's 1.25. That means the property's got to show that cash flow. And then on the third side, when we include the guarantees, the guarantors, we take a look at everything. So we'll take a look at their personal debt, their personal income, along with the income and expense of the transaction that's being generated, and put that all into a global formula. And as long as the debt and the income covers the debt one time, then they've met that parameter. So nowadays, banks, probably moreover, since we've gone into this inflationary period, are also looking for deposits. As a small community bank, which we are, even though we're not that small anymore, we're about a $2 billion institution right now. We used to be, when I first started, we were at about 300 million 10 years ago, and now we're close to 2 billion. So the amount of growth that we've had at Orange Bank and Trust has been tremendous. We grew about 30% last year, and we became a publicly traded company as well. So we're a little bit bigger than what your normal community bank is. However, most of them have the ability, as Rosemarie said, and I work for big ones. I work for Bank of New York and Fleet Bank and stuff like in Provident before I came over to Orange Bank. And the difference is we have the ability to be a little bit more flexible in some of the formulas that I just discussed. So if you're below the 1.25 times, but you might have 30% loan to value, that might make up and mitigate some of the concerns on the cash flow side, and we can look at that. So unfortunately, with the larger institutions, sometimes if you don't fit into their puzzle, they're on to the next person. They don't have the time, the manpower, or the energy to really try to massage a deal to make it work because of the volume that they have. So, you know, it kind of depends on your personal situation on how you want to do that. But, you know, some people nowadays with technology, the difference between a community bank and a big bank is almost nothing because the products are the same. The fee structure is the only thing that's a little bit different. And, you know, unlike some of my larger brethren, if you wanted to talk to our bank CEO, he's on the first floor of this building here in Middletown, and you can easily contact him if you had any concerns, whereas obviously in a larger institution, you might need to go to another state to do that. But those are the three primary things that we focus on. I'm not sure how you guys are looking, you know, what questions you're getting in the marketplace, but I'm all ears, and advice is always free. I put in my contact information in the chat group if you have somebody on site. If you deal with property managers, we have some great products on our end that help organize somebody who manages several properties and many units. I'm doing construction financing right now for an 8-building, 144 unit apartment complex. I did one similar in the town of Chester a few years ago. So we do a lot of not only multifamily, but a lot of apartment complexes as well from a financing perspective. Construction financing is a whole different thing. So, and a longer story. So if you ever have somebody that's interested in building, by all means, you can send them to us as well, and we can talk to them. And like I mentioned earlier, advice is always free.
Yeah, so thank you, Ed. That was very informative. I'm going to ask anybody if you have questions for Ed, if you either want to raise your hand or put the questions in the chat. And I'm glad that Ed said at the end that I can tell you from my own personal experience, and the beauty of dealing with a commercial bank, I mean a community bank, is that all of the main items, that Ed has mentioned, in terms of cash flow, collateral, person, and even, debt service coverage, a community bank will work with you on all of those things. And, many of the things that he talked about, that they have as criteria, maybe sometimes they don't come up as criteria once you develop the relationship with them. And I mean, they're very creative too, and again, there are some other community banks, they're unfortunately in this day and age, they're fewer and fewer. Over my history, I started with a community bank, which it worked at Provident, they became Sterling, they became Webster. It was horrible, Union State Bank became Key Bank. Okay. For me, it wasn't so bad. I was able to buy my performing loans back from them and refinance with another bank for 80 cents on the dollar. So, but it was because KeyBank suddenly came and said to me, you don't have a 1.2 debt service coverage ratio on your property. We need you to start putting up deposits against that to secure us. And I said, we have a performing note with you for 8 years now. I'm not going to do that. And so, this has been one of the challenges over the years, is a lot of the community banks have gotten bought up by bigger banks. So we have continued to change, but they can do things like, even instead of mortgages, you can do, once you build your relationship with the bank, you can do things like lines of credit and mortgage-backed lines of credit, where you don't have the closing costs that you would have involved in a regular mortgage, yet you're collateralizing, a line of credit with properties that you have that are unencumbered. They also we have done with them when we bought our condominium offices for the Hudson Valley Market Center. They did a construction to permanent with us. So basically they gave us the mortgage to buy the property, but then they also gave us a construction loan on top of it. And when the whole thing was done, wrapped it all up, and we ended up with a 4% loan for 10 years, which is a fixed rate, which is a pretty amazing thing. You won't get that today, but these are the types of things, and you can be a little bit more creative because you're not in the box with these community banks.
Yeah, I put in some information, Rosemary, regarding where rates are nowadays and what rates we look at. So about 11:30 every day, all of our loan officers get a email from the Federal Home Loan Bank of New York, and it lists all of the rates. And typically, what we will do is you can do what is called commercial loan mortgages. You're either going to be doing what's called a 10-20 or a 5-10-20. So a 10-20 is a 10-year straight fixed rate term. It balloons after 10 years, but your monthly payment would be based on a 20-year amortization. On a 5-10-20 just means that you have a 10-year term and a 20-year amortization, but the interest rate is fixed for 5 years, and it will adjust at what the prevailing rate is for the last 5 years of the term. We utilize the Federal Home Loan Bank rate. It's called the 5 or the 10-year amortizing loan rate. And then there's a spread of 2.5% on that. So rates right now running at about 6.5% on a mortgage. Obviously, 18 months ago, that rate was closer to 4%, believe it or not. And so we've had, we're kind of hoping that as the year progresses, it'll start to come back down again. Now, that spread, that 2.5%, is what the bank plays with in regards to how strong of a package they get from the borrower. So let's say those 3 parameters I gave you, let's say somebody walks in here and their debt service coverage is over 2 times and the LTV is 40%. and they have impeccable credit scores, then we can play around with that spread because that's considered less risk to the bank. So we can lower that spread to 2, sometimes even 1.5 over the index. There's typically a 1% commitment fee. But again, if you have a large relationship with the bank, that's a commitment fee that they can kind of play around with a little bit. The items that the bank really can't do anything about is the appraisal fee that's direct from the appraisal company right to the borrower. And environmental. Now, if the mortgage is less than $1 million, then we can get away with what's called a Vericheck, which is essentially a credit report for the property, and they don't have to do a phase 1. But if the report comes up with any indications of anything, then they're likely to have to do a phase 1, which costs somewhere between $1,500 and $2,000 to do. And if the phase 1 comes back with even more issues and they have to elevate that to a phase 2, then you're talking about a cost that can get in excess of $10,000. Typically, the only areas where we might see a problem is if you have a property that had any sort of auto repair business, a gas station is going to automatically go to a phase 1. A dry cleaner, if there was one located on there throughout the history of the property, that would provide for emphasis on a phase 1 as well. So you'd have to kind of take a look at that, as you go. And those costs, obviously the mortgage tax from New York State, and I believe if you're in the town of Warwick, I don't know if anybody else in Orange County does. I think the town of Warwick charges an extra quarter point on top of the New York State mortgage tax as a village or a town mortgage tax as well. And then obviously the borrower would have to pay for their attorney, and they pay for the bank's attorney as well. So those are and the title insurance. So those are the primary closing costs. So as you can, from what I'm telling you, you can kind of hear, it could get very expensive as far as closing costs. But if there's enough equity and stuff in the building, sometimes we finance some of those closing costs as part of the loan package.
Okay, I saw Paul Hakeem with his hand up. Paul, do you have something you'd like to say?
Yeah, hi, how are you? Nice to meet you, Ed.
Good.
So can you just talk a little bit, I think it would be everybody's benefit to understand the importance of building the pro forma for a property, because in the Hudson Valley, we see so many situations with, rents that are $1,000 that should be $1,300, $1,400, not necessarily needing a construction loan, but needing attention, a lot of times, and a little bit of management. So, talk to that a little bit so everybody, knows to build that model and present to you properly, because the underwriters are not going to be creative with their numbers.
No, they're going to take whatever you give them as gospel, so to speak. So if you have, there's obviously a lot of different situations where pro forma would be extremely important as part of the package you give to the bank, in addition to the historical numbers that the property is providing. And some of the reasons might be either the current owner might lease some of the space themselves. So typically they would underpay rent to themselves. In some cases, not pay rent at all. So the property would not be showing rental income from a unit or two that the owner might be using, that once it's sold is not going to be the case. You're going to have a new tenant come in, they're going to provide rent, things of that nature. So in that particular instance, a pro forma is very important. And where do we get some of these? Either the seller already might have, or the buyer might already have some ideas of tenants that will be coming in for either empty space or space that's currently being utilized by the existing owner. And they might already have a pre-signed lease. So that would provide the ability and confirmation in any pro forma that, yeah, the property generated $100 last year and for the last 3 years, but when I become owner, it's going to start generating $200. We just have to, the prospective buyer just has to be ready to step up to the plate to provide the proof of how they're going to get to 100 to 200. A lot of times that's going to be generated by the appraisal. So you might have somebody who owns a building, has had tenants for a long time and really didn't need the cash flow personally, so they didn't really increase rents. So the rents are out of whack with what existing rental income is for a particular property in a particular location. So we'll rely on the appraisal because we're going to get two appraisal values essentially. One is a sales approach appraisal, but also one that's an income approach because it is a rental property. And we'll typically rely on that value more than on the sales approach because that's going to be confirmed with copies of leases and things of that nature. So my suggestion is if you have a prospective buyer who is going to be utilizing the building differently and increasing rents, then the pro forma is extremely important. Not as much as if they're just buying the property and letting it go as is. The other thing you should note that on all expenses, because sometimes people who manage their own building don't charge a management fee. Any underwriter in any bank automatically, as part of the property expense and the underwriting, is going to include a 3% management fee as an expense line item to that building. And depending on the type of building and where it's located, there will be a vacancy rate applied. It might be 5%, it might be 10% if it's office space or retail, but typically it's right around the 5% rate. So if you have a building that historically, for the last 3 years, let's say, has been fully leased and had no vacancies, they're going to still put in a 5% cushion for that.
So I'd also like to add for everybody's benefit, you're typically not on a multifamily, the owner typically is not going to be too willing to give you their pages of their tax return and their schedules. They might have other properties or whatever they don't want you to see. They're just going to give you the raw numbers. So you need to build this little model, and it's pretty easy. And Rosemarie, maybe we can do a APOD, session one day, to show everybody how to construct an easy worksheet APOD type thing, and then show a pro forma one also. So you get a copy of the existing leases and then go on to the rental, whatever rental website is available to find some comps. I get it from Yardi, but there's also some free services out there, and you can build a pro forma pretty easily.
And I think, Paul, and that's a great point, because you will have some of those. If you have somebody who's reporting everything on their personal, you can even get away with just telling them, listen, I don't need any of your personal, but one schedule. And that's the Schedule E that's specific to that property. So if they have multiple Schedule E's because they have multiple properties, they'll only need to provide the one that's related to that one. You'll still probably get some pushback by some people, but I think as long as typically on that Schedule E, it shouldn't have any compromising information that they can just derive that from. The other thing too is, sometimes we have the realtors make an arrangement where they can see it, but not the buyer nor the bank, and they can utilize the figures that they can see from the Schedule E just to confirm that the information you have for the listing is actually accurate with what the historical results are for that particular property.
Okay, thank you. Vedetta, do you have a question? She has her hand up. Okay, maybe not. Maybe she hit it by accident.
Yeah,
Okay, anybody else with any other questions? Because if not, we're going to thank you, Ed. You are certainly welcome to stay on if you like. We're going to go for about another probably 25 minutes, and it's going to be a quick 25 minutes because we're going to go over tax strategies for your income taxes. And I guarantee you, if you utilize any or some or any of these, you will save thousands if you have the ability to utilize them. That said, I also want to say I'm not an accountant. Anything that I tell you, you should verify with your accountant or CPA to make sure that it is something that they are okay with and that you qualify for. So again, we're not going to go into like big details. Some of these are a little complex when you get into them. So I'm going to give you the overview today. And it is early enough in the year so that if you feel that we need to go into any of these in more depth, we can do that on the next Wealth Building Mastermind. So I'm going to start with pay your kids. Okay, you have an LLC. You can pay your children up to $13,350 from your business. And they do not have to claim that income. You claim it as an expense on your business. What can your kids do for you? You have to verify that your kids are doing something. They can do filing, they can do social media. They can go to events and introduce you. You can, have pictures of them on your social media. They're models. Models make a lot of money. So, this is a great strategy. When you do that, you get a debit card for them. You can pay for their school, for their sports through that $13,350 that you've paid them. Okay, so you really get a big tax plus from that. You can also use that money to start a 529 or a Coverdell education account for them, or even a Roth IRA. Okay, and there's big benefits in that, and there's a lot of investment strategy behind that as you go down, and we'll probably talk about that at some point later in the year. And just on the Roth IRA, this was an incredible statistic somebody showed me last week, that if you put $500 a month into that Roth IRA, which would be $6,000 out of the $13,350 that you're giving them, and you do that and they continue to do that for 50 years, they would have $120 million, okay, at the average saving rate. So yeah, just a little something to think about. Okay, number 2 is the Augusta rule. This is section 280A in the tax code. This was gotten as a tax law by some rich folks down where they have the Masters golf tournament in Augusta, Georgia. They would rent out their houses during this golf tournament for a couple of weeks a year. So the IRS now says that you can rent out your house for up to 14 days per year, and any income you collect on that, you collect tax-free, and you don't have to claim it as income. Providing, again, it's a personal property, not an investment property. You can also, you don't actually have to rent it outside to somebody else, because again, you have an LLC. You can have a monthly board of directors meeting in your home. Again, you have to substantiate this. You have to go to a local hotel or meeting venue, get information. How much do they charge per day to rent out their facility? Okay, and you have to have this backup documentation in order to say, this is why my LLC paid us $1,000 a day. It's because that is the going rate in our area for a room. So again, now you can take whatever you're paying yourself, deduct it, and not have to claim it as income. Section 199A. Okay, if you again have an LLC or a sub S corporation, since 2017 has allowed you to reduce your qualified business income by 20%. And all I'm going to say about that is your CPA should know about that, and you should ask them about that. That's section 199A. Section 179 of the tax code allows you to fully depreciate and not amortize any type of equipment, vehicle, software. I see Nate Caney smiling over there because I know this year he bought a truck and he is deducting that whole truck. So he's not depreciating it on his business. You are allowed still in 2022 to still deduct 100% in this current year. Starting in 2023, it will be 80% deductible in the current year, and then the rest depreciated. So again, you should ask your accountant about section 179. If you own rental properties and you are going to hold them for any period of time, you probably want to consider doing a cost segregation study. Okay, the most buildings that we buy our accountants depreciate over probably 27 years, and they depreciate everything in the building like that. When you think about it, there are parts of the building like heating system, like a hot water tank, like appliances, carpet, paint. Those are not assets that we can expect to have a 27-year life. So in cost segregation, they are allowed to, a company comes in, you have to pay them to do a study. I'm going to give you the name of a company. It's called US Tax Advisors Group. They will do cost segregation studies for you. They have a website. It's US, T like Tom, AGI.com. Maybe Aaron or somebody can type that into the chat. USTAGI.com, US Tax Advisors. They can come in and do that study for you. They will take those assets that have the lower lifespan, and you can now take that deduction in the current year. You can also go back, I believe it's 5 years, if you put an asset into service during that time, and you can file amendments to your return because you have to start it in the year that you put the asset into service. So again, that's something a lot of accountants don't know about this. You can get the information from US Tax Advisors. And they can tell you, they will actually, I believe, do a little analysis for you as to whether it will benefit you or not to do it. Generally, they say about 30% of the value of a property is approximately how much in a cost segregation you would end up with as a first year deduction. So. And I see Nate Keeney with his hand up. He probably has some info about this.
Yeah, I actually just got back here and joined on late because I just met with a client for lunch. I helped him buy his first investment grade commercial property last year. It was a $1.8 million acquisition. He just spent $3,700 on the cost seg study, and he has figured out that he's going to get $500,000 in deduction in year one when he does it. And so now he's applying that to everything. And he's, he works a full-time job, but he's working to become an accredited real estate professional so that he can do more of this stuff. And so now through all of these, tax benefits, he's looking to plan to allocate, 90% of his annual income to reinvestments and more new deals. And then you mentioned that a lot of the depreciation schedules are 27 years. If you're doing duplexes, fourplexes, apartment buildings, it's 27 and a half. But if you do anything more specifically commercial, it's on a 39-year schedule. And so then that cost seg study becomes even more beneficial because you're depreciating less in a normal scenario every year.
Mm-hmm.
It's it varies greatly between asset types. So if you're doing apartments, for example, in multifamily, it's about 65 cents on the investment dollar when you do a 70% mortgage. So if you buy $1 million 4-family, get a 70% mortgage for $700,000 and $300,000 in equity coming in, it works into about 65% of your equity comes back to you in accelerated depreciation. So on that 300,000, that comes back. On a hospitality property, it's about the same ratio. And if you get down into like industrial is probably the lowest. I believe the one that Nate was referencing is mixed use. It's office and some apartments, Nate? Or is it just all office? So office.
Sorry, I was muted. It's office. It is mixed use. It's office and apartments with potential to change the ground level to retail.
Yeah.
Okay, do we have any questions? I know that was a lot of information in a really short period of time, but I think it's invaluable information that hopefully you can use and because, you know, it's not just about making the dollar, it's about keeping the dollar you've already made. And somebody who I consider Brett Tanner, who's running KW Wealth, he said last week you should spend about 20% of your time working on keeping the dollar you already have. So I thought that was an interesting quote. I certainly don't spend that much time on it, but he's given me some ideas that I have to spend some more time on it. So
We
anybody,
always say it's not what you make, it's what you keep.
there you go. That's it.
And it's a really good conversation starter for, you know, a cocktail hour and building a relationship with potential clients.
Love that, Nate. Anybody else with any questions? Okay, well, this was a fast-paced day. I hope you learned a lot today, and we will see you next month. If there's any particular topic you'd like to hear next month, please shoot me an email. Okay, thanks a lot, guys.